depreciation expense of $300, and that's going to be part of our clad also. That's the amortization and depreciation. So let's drop that in real quick. And it's depreciation, so let's see, that is included in net income, but it didn't take any cash. So we're going to add that as increasing cash, and I've stuck that here in the accumulated depreciation column, but you'll see in depreciation expense I've added that back, so that's an increase in cash. So we've addressed that. During the year we had a transaction where we disposed of some equipment. So the equipment had a cost of $1,000. The accumulated depreciation balance on that equipment was $500, and we just threw it away. So we had a loss on the disposal, and those are all posted over here on the equipment and the accumulated depreciation accounts. So I need to address that loss on the disposable equipment. That's included in net income, but again, that didn't cost us any cash. So we're actually adding that back. Here's the equipment column. There's the $500 that I've added back for loss on disposal of equipment. Next, and let's go ahead and finish up the equipment. I did show that we purchased some equipment during the year of $1,300. So cash went out the door of $1,300, credit of cash, and debit equipment account for $1,300. And this gets us to our ending balance in equipment and accumulated depreciation with the transactions that we've just talked about. So in my investing section, I've got $1,300 going out the door as a use of cash in investing. So the company has invested $1,300 in its equipment. That's a use of its cash, which is down here in the investing. Let's finish up the operations section. So we've done the losses and gains. We've done the amortization and depreciation. Last one is deferred taxes, and in this example I didn't give you any deferred taxes, so we don't need to worry about it. So my net cash flow from operations, all I've done is I've taken my net income and I've totaled up all of my changes related to the current assets and liabilities, adding back the losses on the disposal of $500 and adding back the depreciation expense of $300. If we had had a case where we had a gain on the sale of equipment, well, that gain isn't related to cash, so we would have actually decreased that from our net income. But here we've got a loss, so we're adding it back. The net here is $2,600, and that is our cash flow from operations for the year ended 2009. Next, let's go down to cash flows from investing. Remember OIF. So here's investing section. The only thing that we invested in this year, we had purchase of equipment of $1,300, and that's dropped over here in this column. And now if we look at our equipment and accumulated depreciation accounts, the total change, the equipment went from $4,600 to $4,900. That is an increase of $300. The accumulated depreciation went from $1,400 to $1,200. So accumulated depreciation decreased by $200. With our depreciation expense, our purchase of new equipment, and our loss on disposal, we've dropped those into these two columns, and we've netted out the two equipment and accumulated depreciation. So we have dealt with all of the change in those two balance sheet accounts. So we're done with accumulated depreciation and equipment. We've addressed all the changes in the statement of cash flows. Last thing we need to deal with is cash flows from financing. So we're going to look at what's financing this business. Dividends, which that's going to have to be a given, but we could have actually figured that out as well. You remember we looked at the change in retained earnings. It went from $1,550 to $1,000. Change of $550. Well, $300 was net income. That would have increased retained earnings. So in order to make the change foot, to make it zero out, we have to have something else that reduced retained earnings by $850, and that was dividends paid. That is part of our financing transactions for this organization. So that reduces cash by $850. We simplified the bonds payable section. We started off with a beginning balance of $4,500, end of the year balance is $4,000. $500 decrease. That is a use of cash because we paid off some bonds. So that is in the financing section. Last item, we have common stock. It went from $1,200 to $1,500 because we sold $300 worth of common stock, and we've pulled that over as a increase in cash. If we sold stock, someone gave us cash for that stock. Now we have addressed all of the changes in those balance sheet accounts for the year ended 2009. So we take our cash flows from operations, which is $2,600. We reduce it for our cash flows to investing of $1,300. And then we subtract out cash flows to financing of $1,050, and that gives us a net change in cash of $250. And that makes our statement of cash flows work for the year. This is a really good statement because we can see what's going on in an organization. In this organization, we have cash flows from operations of $2,600, and we're going to hope to see that in organizations. We want to see that a company is producing cash from the business that it's in. That isn't always going to be the case. In an early stage business, it may take many years before a company generates cash. The cell phone industry took more than a decade before they were producing cash from operations because it took such a huge investment to get going. We do expect to see that companies are going to have continuing investment. If you see a company that is actually producing cash from its investing, what does that mean? Right now we've got some large organizations like General Motors, and they're selling off assets. They're selling off their investments in other companies because they need cash. So what does that tell you when a company is producing cash from its investments? It means it's selling them off. There's nothing wrong with that, but we are going to expect to see if a company is growing that they are continuing to invest in their business. And cash flows from financing, I'd like to talk to my students about, can you think of organizations that get by just on financing? Think back to the dot-com craze in the 1990s. There were a lot of companies that didn't have any customers or no revenues, and all of their money came from investment of shareholders who are looking to get in and build market share. This is neither good nor bad. Sometimes it worked in companies like Amazon, companies like Google. Sometimes it didn't work. Pick your own .com that you heard of that was never successful. So by breaking out our transactions into this format, we're able to see kind of what a snapshot picture, a little bit different view of what's going on inside the organization. So I hope this has been a good little primer for what a statement of cash flows is attempting to do. If you use this method of laying out your balance sheet and coming up with what are the changes in the balance sheet and then addressing those changes and dropping them into the appropriate section of the statement of cash flows, you'll always make sure that you can always balance your statement of cash flows, and that if you ever you can't get it to balance, you're at least going to know what accounts it's related to that you're having trouble balancing it.